to give a shout out to Paul Montague. He's a tax preparer here in the Vancouver area. If you already know that you need a tax preparer, or you decide after this that you want a tax preparer, feel free to reach out to Paul and see what kind of options and rates. But he's somebody that we do refer people to. But mention you're part of Business Pod, because we're right in the middle of tax season, and he's not really taking new clients unless it's a friends and family sort of situation. So just let him know that you're part of this, and he'll help you out. So today, there obviously the tax code is thousands and thousands, probably tens of thousands of pages long. So today I want to go through some of the business tax basics, some tips and tricks along the way, what kind of records you should be keeping, talking about just tax planning and strategy, estimating taxes, things like that, and then get into the nuts and bolts of what income should you be recognizing, how, and what kind of expenses you can deduct. There are a few tax updates that I think will be relevant for some of you that are on here, and then just some common tax challenges that you may face. Based on some of the polling questions as we go through, I may dive in deeper in certain areas. I've kind of anticipated who I think was going to attend, but if you have some specific questions, feel free to pop them in the chat, and we'll try to get to those along the way or toward the end. I'm hoping to try and get through most of my content by 4:30 so that we have some time to answer specific questions if people have them. Okay. So I would love for you to pop into the chat if there's anything specific that you're hoping to learn today. And we can try to make sure and answer those questions, or go and do some research afterwards to help you out. So I'm seeing best bookkeeping practices, making sure you get all your deductions, first year business tax benefits. So I read that, Alyssa, as like startup costs and things like that. If there's other stuff that you want to talk about, we can add that too. So that's great. All right, well, let's start out with a few basics, and I'm going to go ahead and launch a little poll here. You don't have to put it in the chat. I am going to try to be snazzy here. Question, nope, back, sorry. All right. Hopefully that's launching for you. So what kind of business entity do you have? So if you don't know, or if you haven't formed yet, I'm seeing one of those of y'all. This might influence you a little bit as we go along and you hear some of the requirements in different spaces. But in the poll now, and just kind of see where everyone's at. So most people LLCs, which is what I would expect. LLP, which is great too. And then somebody that maybe hasn't filed yet. So that is great as well. No S corps. I do have a little bit of information, but actually not a ton on S corps. And if you are considering shifting over to an S corp at some point, let's chat about that. I will mention a couple of things that are going on later on with things like qualified business income deductions that might sway or change your timing on that S corp shift. Okay, so this is kind of starting with some of the basics, so I won't belabor it too long. But for most companies, you're going to be using January 1st through December 31st as your tax year. You can file differently if there's a lot of retail businesses will have March 31st as their year end just because of how the ebbs and flows of selling things works. And if you have sort of a different cycle, you can file to have an exception to that. But your personal taxes are going to be January 1st through December 31st. So for most of you, the simplest thing to do is just to leave it from that time frame. The other thing is that most small businesses will use a cash accounting basis. There are situations where what we call accrual accounting can be used. And what accrual accounting is matching your income and your expenses kind of to each other versus from a timing standpoint. So in other words, in some businesses have deferred income recognition because they haven't provided the services, but they've received the cash. Sometimes you defer expensing something to match up with the associated income. If you deal in large amounts of inventory, you may be in a situation where you, what we call capitalize that inventory, and then you're able to recognize that as an expense over time as you sell that off. So that's probably the most likely scenario. And there's then some cash to accrual adjustments that you can end up making for tax purposes. I don't think this applies to most of y'all if you extend long-term credit. So I don't mean accepting credit cards. I mean if you're somebody that lends somebody or someone buys something on credit, then accrual can be beneficial. But I would say for most of us, that's myself included in the business I do, just use cash accounting. So I sell a product as part of my business, and when we buy inventory, we expense that in the year that we buy the inventory. So that is totally fine, especially with the amounts of dollars that we're talking about. We're not talking about, for me, unfortunately, not millions of dollars. We're talking about, thousands or tens of thousands. So it's not, it really is not going to be a problem to expense that when you get it. So that's one thing. And if you have questions about that, we can talk about whether there's alternatives that you want to use. So this is something that I end up explaining a lot in consultations I do. And so I wanted to make this clear to folks how this works. If you're a sole business owner, you own your LLC 100%, or maybe you're in a partnership and there's a couple of you, this is going to be true. You are going to be taxed personally on all of the net income that you make in your company, regardless of whether or not you actually distribute all of that income out of your company to yourself personally. Okay. Sometimes I think people think, oh, I've done a distribution or taken a draw from the company, and that's all you're going to get taxed on for income. And that is not the case. So if you make $50,000 and you've drawn $30,000 of that out for your, personal bills, and you're, paying yourself a salary, essentially, you're still going to get taxed on the $50,000. And so just make sure that you're prepared for that and that you're setting aside money to address, paying the government either estimated taxes or at the end of the year, because that can be a little bit of a shock for people. If you are part of a partnership or if you're an S Corp, and this is true, like if you're an LLC, but there's 2 owners or 3 owners or 4 owners, you are going to prepare something called a 1065. And then that is your tax return for the LLC, LLP, or S Corp. Well, the S Corp is I'll show you the numbers on it. It's a different form, but you will prepare those and then you'll get what's called a K1. That K1 is your personal slice of the business that you will put on your personal tax return. So if you're a 2-person organization, that 1065 is going to show the tax liability, excuse me, the net income for the entire organization. The K1 is your portion. If you have an LLC, an S Corp, LLP, those are due on the middle of March. I'll show you the specific dates. If you are a sole LLC owner, that is due when your personal tax return is due. So there's a little bit of difference there. If there's any situation where folks answer that they're part of an LLC, but you're paying yourself W-2 earnings, which can be the case. If you're issuing yourself a W-2, you're running payroll for yourself, those wages that you've received would go through line 1 of your personal 1040. The remaining income, so like we had said, like maybe you run payroll and back to this $50,000 example, if your net income share is $50,000 from the business, but you pay $30,000 of that, you paid yourself in W-2 wages, the remaining $20,000 will flow through to a different part of your tax return. So that will be going through line 8. So as I mentioned, this recording will be available. Feel free to take snapshots, et cetera, of pages if there's any details, because I know I'm saying a lot of acronyms and a lot of form numbers and things like that, but welcome to the IRS, right? Okay. So I know there were some questions about record keeping. Excel is fine. I love Excel. I'm a finance person. My brain thinks in Excel all the time. And depending on your, track number of transactions and all that kind of stuff, that can be a perfectly fine way of doing things. And I'll talk a little bit more about how and what kind of records you want to keep. But first, I just want to test your knowledge and impressions of generally, how long should you keep tax records for? And I love this question because this is something that I learned more recently that I had the wrong knowledge about. So most folks said 7 years, which is absolutely, up until this past year, what I would have said was the answer. And I probably have 7 years worth of tax receipts and statements and all that in my record keeping. However, it's actually now, and there's lots of reasons why, it's actually 4 years. So, and I checked this now for federal and Washington, and Paul and I had a conversation about this. So, it's generally 4 years plus the year in progress, right? So we're in 2025. You would want to have what, 21, 22, 23, 24, right? Plus the year that we're in. And that is true for federal and Washington. Generally, the IRS is going to look back 3 years if they audit you. But if there are things, so there's kind of two caveats with this. If your business owns property, you will want to keep those records for until like 3 years, 3 or 4 years have passed of when you've gotten rid of it. So that kind of includes if you have a home-based business and you're taking, a home business credit on your taxes for, that portion, your home office, you want to keep those records, that portion of records until you sell the property. So that's kind of the caveat. The second thing is in cases of fraud, they may go back indefinitely. So I just said, don't do that. Like, don't commit fraud. But if you're doing something funky, err on the side of keeping your records as long as you can. Two things. One is if you get receipts from places, a lot of people will stick those into a shoebox for a year in some warm area of their house, and then they will open it up at year end to try and track their records and find out that those receipts have faded and you can't read them anymore. So just be aware that a lot of receipts today are printed on thermal printers. Those receipts will fade. And so if you want to keep them, you want to digitize them in some way. Now, in my opinion, right, this is more of an interpretation. If something's less than like $100 and it's showing up on your bookkeeping systems, your bank account statements, et cetera, your credit card statements, I'm less worried about you actually having that physical receipt. If it's something like you went and bought a new MacBook or something like that, you might want to make sure you digitize those. So, I try to be practical because I know that you don't have a lot of time. You don't want to be spending your days scanning receipts and whatnot. But, sometimes if you're going to Home Depot and buying something for your business and they offer you to give a digital receipt, do that so that you can easily have those records. The other thing is, when we were talking about, I said, I love Excel. It's great. My hobby art business that I've had for 20 years, I just use Excel for that. For my day job business, we use QuickBooks. There are lots of other alternatives. And the benefit of that is that you can have your in those bookkeeping systems, you can have your bank and credit card statements flowing through there and connected. So that is one benefit to that of having a bookkeeping system as opposed to just a spreadsheet. So depending on, what kind of money you are spending and whatnot, and what you're earning, it can be a pro con. So certainly can give you more specific things for your circumstances if you have questions. Okay, so I just want to kind of know from y'all where you're at in whether or not you're using a tax professional, just so that launch this one. Just so I know, how much detail to go into some of this stuff, because some of this, if you're using a tax preparer, some of this you don't need to know. It's a real mix. So share that. It's a real mix there, but there's folks that are trying to self-prepare, so I'm here for it and try to help you along as much as possible. Okay. So a couple of things about tax planning. Number one, when you have your own business, you probably recall, if you've ever had W-2 earnings, or if you still do, that there's this portion, about 7.6% of your wages that are held for Social Security and Medicare. When you're self-employed or have your own business, you will have to pay both portions, both the employer and the employee portion of that, and that is 15.3%. This is where you get into a whole bunch of discussions about, is it a good idea to become an S corporation? Because then you can manage a little bit better how much you're paying yourself in wages, and therefore how much Social Security, SECA taxes that you're going to pay. The law does permit you to, it's a weird thing, to deduct the self-employment tax as a business expense. So it ends up effectively not being 15.3% in total. But, let's just say for giggles, it's around probably 10%. So sometimes people want to avoid this. Couple PSAs, right? Your Social Security money you're paying in, that is your money. So as they're looking at defunding potentially some of that stuff, that is your money. So you're paying into it and you want to get that back later in your life. The lower that you establish your own wages, so if you say, I'm going to pay myself W-2 so I don't have to pay this, that is what the Social Security will recognize as your wages. So if you take it 100% for your business, then, you will get record of that full income on your Social Security record. If you decide to lower the amount that you're paying yourself through W-2 to avoid some of that tax now, that just means that your Social Security benefits may be less in the future. I've got in here what the maximum taxable earnings are for those SECA taxes. So if your business is, your portion of the business is earning more than 168,000, you won't pay taxes on that amount above that. The other thing is you want to make sure you're paying your estimated taxes. So, and that includes making sure that you're paying some estimates on those Social Security taxes. Here's just showing when those are due for the next year. And, there's two ways, there's a couple different ways that you can file it. Like there's an app and all that stuff. But I would say if you're sitting on your computer doing it through irs.gov and say that you want to pay estimated taxes, that's a really reliable way to navigate. Or you can do it manually through Form 1040-ES. The other tip right now, if you have concerns about privacy and giving your bank account information out to have estimated taxes taken out, I know some people are concerned about that. Making sure that you're using a bank account that doesn't have the stockpile of all of your on-hand cash. You might want to use a working account that you don't have you don't keep a lot of your business retained earnings in, just for, fraud from anybody, right? Getting that bank account number. So that's just a little new tip. The other thing I have to say is, like, as y'all are aware, regardless of what your opinions are about what's happening out in the world right now, there are a lot of changes happening, right? So something that I'm telling you today could change very fundamentally in the future. So, try to pay attention to where tax law is going with some of the administrative changes that are happening. Okay, this is probably the pure nuts and bolts of what you want to get into. This is a place, feel free to come off mute and interrupt or throw something in the chat if you have a question that, you think that the group would benefit from hearing. Because if you have that question, probably a lot of people do as well. If you have very specific questions, I'll just ask that we hold those until the end and we'll come back and try to answer them. Okay, income. So we talked earlier about cash versus accrual accounting. So generally, your tax income is going to be based on cash receipts, right? When you receive the cash for whatever transactions you're doing. So if you're a business like mine, where I have invoices and I bill, and there's like generally like a net 30-day payment agreement with some of my clients, I recognize that income when I deposit the check. For those of y'all that are maybe doing a lot of credit card transactions and things like that, those are going to settle really rapidly. So maybe you only have a day or two at the end of the year that you haven't received money for that. So just pay attention to those cutoffs and what you've got in there at the end of the year. Also make sure, you know, if you're in my boat and people maybe take a month to pay you, that you're including anything that you had invoiced in 2023 that you didn't that you received in 2024. Now, if you use something like QuickBooks or some of these other online tools, and you're running reports to figure out your taxes, there often will be a default. So QuickBooks defaults to running accrual reports. So make sure that you're pushing that toggle button in QuickBooks to go to cash, and that's going to tell you what you actually received in cash for your income. Same thing with expenses in those reports. You know, just make sure you double check that it's running it for the full year for last year, and that it's doing it on a cash basis. You know, again, coming to practical tips, I get questions about, you know, oh, I got cash tips or cash sales or whatever. Technically speaking, all of that is recordable income, and you should be tracking that. The things where are you going to get called out, especially? If you've given out what's called a W-9 to any of your clients, that is what is triggering you to receive a 1099. Usually those are going to be called 1099 NEC or non-employee compensation. So in those cases, when you're receiving 1099s, you definitely want to make sure that you are counting all of that income and don't underreport your income where you've received 1099s, because the IRS gets that. They have computer programs that run, and if you've, you know, left out a couple thousand here or there because you didn't know that you had that income, but 1099s were issued, you're more likely to be subject to an audit. So, you know, we prefer not to be audited. So check that out, make sure it's matching. If you over-report, right, obviously they're less concerned about that. A couple of things that, you know, common errors or things that people also forget. Sometimes you might sign up for a bank account that gives you a bonus for, you know, how much money or how long you keep it in there. So if you get bank deposit bonuses, make sure you're counting interest income. A lot of the banks today do not send out 1099s for the interest that you're receiving. It's all online, especially if you've signed up for online statements. So make sure you go into your bank account and pull those 1099s for any interest income that you might have earned on bank accounts. I'm going to talk separately about income collected through cash apps like Venmo, Cash App, things like that. I'll talk more about that in a minute. The other thing that Paul reminded me to note to y'all around W-9s and things like that is, I assume in this that all of you have received an EIN number from the federal government. If you haven't gone to get an EIN yet, please do go get that. So that you're not using your social security number for any of your business transactions. It's free to do. You do not need to pay. They have paid services people try to get you to do. You don't have to pay for it. You can just go to the irs.gov and go get an EIN. So that is pretty straightforward. If you need help doing that, I'm happy to help. There is something called Schedule 1 that for those of you, this is a bit more of like deep cut, but for those of you that are self-preparing, I wanted to mention this. Schedule 1 is where you are going to see the income or loss from a business flow through on that schedule. Now, if you're using something like TurboTax or another tax prep program, you will not have to know, oh, this has to go on Schedule 1, this line item, but just know when you're reviewing your taxes. And I highly suggest if you have someone even preparing it, go through your return and make sure things look reasonable to you, because mistakes get made, right? So Schedule 1 is going to show where your income or loss from a business is flowing through. One other thing to note is your schedule. So Schedule C, for any of you that have an LLC that you're a sole owner of and not receiving a K-1, Schedule C, reporting income or loss from a business, that is going to be where things are going to flow through for you. So that is going to flow through there. And then you'll also see that income on Schedule 1. Schedule 1 is also where you're going to see the deductible part. So I've got some things that are relevant here in gray. The deductible part of your self-employment taxes will be on Schedule 1. And that is also going to reduce things that will reduce your AGI, your adjusted gross income. There's some things like the part of your self-employment taxes, things like that. So that's going to reduce your income. So Schedule 1 is something that you will want to make note of. I think I have it. Well, I'll go to the next page because I think we've got more stuff. Well, start putting in the chat as we go along also what business expense areas you have questions about, because these can get very specific. And so I'm going to dive into deductible expenses next, now that we've talked about income, and happy to kind of get into some more of the details. So deductible expenses. Let's see if I can. Nope, I didn't want to do that. Sorry. There we go. Okay, deductible business expenses. So there's lots and lots of them. I am travel and meals, health insurance premiums. Lorna, I see your question about estimating taxes. We can come back to that one too. Sorry, I missed that one. Okay, so this is the whole host of deductible business expenses. Don't hesitate to, track and deduct things that are business related. And so what's business related, right? So travel. The travel, meals, and gift expenses are a lot of times where people try to be pretty liberal in their deductions of things. And what I would say is if it really is truly business purpose and you can justify that, if it is, something where you are having a brainstorming meeting with some, network pals and you're talking about your business and you have a meal together, that is deductible. It's deductible at 50%. And the reason for that, the logic behind that is that, you have to eat anyway. So they don't allow it to be fully deductible. If that seems in alignment with the percentage of like what your business is doing. So in other words, if you're like, I'm going to take a trip to Aruba and I'm going to business expense that as travel expense from my company because I can justify that I had a meeting while I was there or something. If that's like really putting you into a tax minimization situation, or is taking you into a loss situation, et cetera, there are going to be limitations to that. And that is just more likely to set a flag. Some of the tax programs will kind of give you a audit risk score after they go through it. And so if you're, expensing tens of thousands of dollars of travel and meals and things like that, but you're only, making five figures with your business, no judgment there other than you're maybe more likely to get called out. So that's travel, meals, gift expenses, things like, I'm parking here, parking kitty, things like those, all of that can go into, travel expenses. Presuming that it's, out of the ordinary from, where you work every day. Speaking of out of the ordinary of work every day. So mileage and car expenses are another common one. And this is one I think that people a lot of times will underutilize. So there's two ways that you can deal with car and truck expenses. First of all, you can deduct actual expenses, so actual gas, actual repairs, things like that. But I would say that that's less common for a lot of the businesses that I know that y'all are running. Most of us are going to want to deduct the mileage associated with business trips. And so that's at like 67 cents for this past year. And it generally goes up every year per mile. So how I would suggest that you do this is, keep track of that mileage somewhere, depending on what level of bookkeeping system, you're using. Sometimes you can track it directly in there. Yeah, I use a spreadsheet to track all of my trips based on my calendar, right? So I just kind of go through and say, oh, where have I gone? Let's say you have a home-based business and you drive to a client or you drive to Office Depot or Staples or something like that, figure out how far that was and claim that. For those of you that have retail shops where or a place, an office that you go to for regularly, technically speaking, you are not supposed to deduct your back and forth every day to that, because that is like similar to, you don't deduct it if you are working for someone and you drive to work every day. But like I said, if you're mostly home-based and you go around to different places, or if you have a retail establishment and you go to a networking event like business after hours, deduct that. And it adds up, right? So when I say it's underutilized, I think a lot of times we think, it's no big deal. But, you drive 10 miles, that's a $6 deduction there, right? So definitely suggest that you take advantage of that and track that. Let me touch on some other things that I think are frequent things that you want to make sure you're deducting. Licenses. So business licenses, your LLC renewals, changes, any of those filings, make sure that you're deducting that what you've spent on those. Licenses for, I'm a CPA, so I pay CPA license. I deduct that. So keep track of those. Obviously rent if you're paying for an office or a retail space. I didn't feel like we had the time today to dig deeply into home office deductions, but kind of as the yin to the rent yang, like, if you own your home and you have a home office, we can, answer questions later or another time and go down that rabbit hole of how that works. But definitely, take advantage of that if that seems advantageous. Professional expenses. So if you're paying for a tax preparer, that is deductible through your business. If you are paying for web design services, things like that, those are all deductible expenses. Taxes and interest also can be deductible depending on what those taxes and interest are. So if you're paying out interest on credit, things like that can be deductible. One of the ones that sounds confusing. So your website, your e-commerce site, your Zoom subscription, your QuickBooks subscription, any of those software things, that all goes through office expenses and software. It's not totally intuitive, but that's where it goes. So for many of you, that is going to be one of the largest categories of expense. Obviously, that also includes pens and notepads and any sort of other office supplies. Advertising expenses, right? So obviously, if you're doing paid media of any kind, you're going to put that into advertising and marketing expenses, 100% deductible. That is also where I would put things like business cards, flyers, any sort of promotional materials that you're handing out at events. All of that would go into advertising expenses. Self-employed health insurance is deductible through your business. I know that there was a question about this, and that might be something we could, either answer at the end or take offline to kind of get into where and how you do that. The other thing is there are, for small businesses, different retirement plan options, like a SEP that you can set up, and you can deduct those contributions to those retirement plans through the business, or depending on how you're structured, that also can be deducted on your personal taxes. And so those are great ways to, if you want to contribute to a retirement plan, that you can reduce your business tax liability and save for the future. So that is something else to look at. Also, if you're paying for online classes, in-person classes, professional organizations like GBC, if you have a membership places, make sure that you're deducting all of that stuff as well. Okay, I'm going to move on, but if you have any other questions about deductible expenses, let me know. Okay. One other thing about income that is a newer thing, and want to make sure that everyone is knows what's happening. So sure, many of you know of PayPal, Venmo, Stripe, Square, Cash App, all of these, what they're called TPSOs, or third-party settlement organizations, that help to take payments and pass them through to you. They are now required to report those transactions through what's called a 1099-K. So in the past, people were kind of just using cash apps to avoid, tax liability on that income. And so they're kind of closing that loophole. So, but they're gradually phasing it in. So in 2024, if you had transactions in excess of $5,000 through any one particular cash or TPSO, they are required to send you a 1099-K. Again, if you haven't received something physically in the mail, I would go and log in and make sure that you're not just needing to download that, because that could be the case if you're getting statements online. So for 2024 transactions, if it's over 5,000, they're required to do it. For 2025, anything in excess of 2,500, they'll issue you a 1099-K. And then in 2026, it'll be $600. And that will then fall in alignment with the 1099 non-employee compensation rules, which also say $600. One thing I forgot to mention when we talked about professional expenses on business expenses. I know some of you are in this situation where you are paying other professionals, web designers, tax preparers, et cetera, more than $600. Depending on, your relationship with those, typically the tax preparers, you aren't like required to send them a 1099, but web designers, other service providers, I will hire contractor cons consultants. Anybody that you're paying over $600 legally, you are required to issue them a 1099. And that should have been done at the end of January. So if you are in a situation where you paid a subcontractor or a web designer or something last year more than $600 and you didn't do that, let's have a chat about what you need to do for that. The other thing is I would highly suggest if you're using Venmo, Stripe, Cash App, like these different apps, if you can keep your personal transactions out of the account. I know with Venmo, it's hard because they use your phone number. Make sure that you're not paying for stuff that's coming through a 1099 or for things where you sent somebody sent you money because you paid for a meal and they're reimbursing you. That is where you want to go back to that Schedule 1 that we talked about. In the top box, you place in there any personal payments so that, maybe you got $3,000 worth of personal payments through Venmo and only $3,000 worth of true income. You want to make sure that you're not double paying on that. Let's come back, Megan, to your question about mobile business. I don't know if you want to ask it now or you want to come back to it.
We can come back to it.
Okay.
It's fine. I was just wondering about like deductions for like trailer and car because we just briefly touched on it, but that's a different thing. So.
Yeah. Let's make sure, and if we don't get to it by 5 o'clock, let's take it offline and we'll make sure you have the info you need.
Okay.
There's also a question about internet costs for a home-based business. The answer to it is technically yes. However, it used to be more aggressive, like businesses would really, really need the internet and like regular people didn't always have it. Most people pay internet costs, right, to have internet delivered to their home. And so I wouldn't be super, super aggressive on that. You could justify, hey, I use the internet 50% of the time solely for business, and then deduct 50% of it. That can be justifiable. Again, unless you get audited, no one's going to like dig in and go like, what did you deduct? But like for myself, I do not deduct my, what I pay Comcast internet or whatever. But you could justify it by saying, I wouldn't have this or this level. Maybe you pay for a higher level of service or something because you need reliable connection in a way that you normally wouldn't have. Then you could deduct that. Same kind of goes for phones as well. If you have two phones or you have a landline and a mobile phone, you can deduct one of those, right? Because you could say, normally I wouldn't need to have both. But most of the time they're going to say, you're going to have a phone anyway. So unless you have a separate number and a device for that. Now, can you justify deducting new technology, phones, computers, things like that? Sure. You could justify that you needed, the most up-to-date iPhone or Android or something because you need that for work. So you can have there's a little gray area there.
Thank you.
If you happen to deal in cryptocurrency in 2025, there's going to be something called 1099 DA, which is digital assets, I think is what DA stands for, which is similar to the thing you get for investments if you have stock accounts and things like that. But this will just apply for cyber currency if you happen to be in that business. All right, I'm going to skip over this because I already covered this about not sending out 1099s. And I think Lorna had a great point in the chat about don't wait. Like if it applies for you 2025, make sure you figure out how you're going to issue 1099s as soon as possible, because if you wait until January 30th, you may have trouble or have to pay more to get them issued than you would have liked. I think QuickBooks, it's like $12 a 1099 or something like that. You know, they change their fees all the time, but it's very easy through programs like that to have them issue your 1099s for you. All right, I'll cover a few more complicated things that sometimes come up as common questions. Qualified business income deduction. So this is a good thing, given, you know, the inclinations of the current administration. It's possible that you could see an extension happen with this. What this is a business deduction that, so there was some, if you had a C Corp, there was some tax relief that came out in 2017. And they followed it up with small business relief, which allows a 20% deduction of your qualifying income that relates to LLCs, sole proprietorships, S Corps, et cetera. This is where it gets complicated about if you're paying yourself W-2 earnings, you can't take the deduction for the W-2 earning portion. But if you're just taking distributions as an owner of your company, which if you're a sole owner LLC is most likely what you're doing, you can get, you're qualifying for this QBID deduction through 2025. And it can be substantial depending on how much you're making. So make sure that if you're doing it or your tax preparer is doing it, that you're completing Form 8995 for QBID and taking advantage of that deduction, because that is probably one of the most substantial deduction programs that you're going to have. If you happen to be in a high earning income household and you're like filing jointly and you have a partner that makes a substantial amount of money, there are thresholds of 383 for married couples or 191 for separate singles, head of household, et cetera. But that's a pretty high number. So many of you will be able to take advantage of that deduction. I know somebody had questions about startup costs, and you know this can get sort of nuanced. But if you have startup costs that are less than $5,000, and you establish your business in, you know, they can be, sorry, if you have startup costs less than 5,000, you can deduct them in the year that the business was established. That's pretty much it. So if you started your business in, let's say 2023, and you had what you consider startup costs in 2024, those are just business costs, right? That's fine. But let's say you started spending money on your business in 2023, filed your LLC in 2024, you would deduct those costs in 2024. Costs greater than $5,000 in startup costs, which, you know, if you've got a food truck or things like that, maybe it's more than that. You will likely need to what we call amortize that, which is kind of like depreciation, if you think of it that way, over 15 years, right? So they're saying, oh, these are going to benefit you throughout a longer life of your company. And so you get a portion of that deduction, you know, in 2024 and onward for 14 more years. This is where if you've got a lot of large startup costs, or if you have things spread over multiple years, you know, dealing with your business prior to starting it up, you might want to consult a tax professional because there are some nuances and some reductions in how much you can deduct in a particular year. So a little bit more than we can cover today, but if you have less than 5K, you know, make sure that you're deducting those startup costs. Another common question that I get is about, you know, things that you've paid for personally related to your business. Especially in early days, if you didn't have a business bank account, you may need to get reimbursed personally for that stuff. So there's a couple different ways that you can do this. But I would say try to run as many of your business transactions through your business bank accounts, business credit card, business debit card, as much as possible. That is going to be the cleanest thing for if you're ever audited, especially if you're in a partnership. It's also cleanest because then nobody's going, hey, why are you getting reimbursed for things like that. But there may be some justifiable times. Like I went on a trip this year for business and forgot that my credit card on file at the hotel was automatically my personal card. So, you know, I had to pay myself back for that. Another legitimate situation is if you're using a car that you use for both personal and business purposes, and you're needing to deduct the mileage, the clean way to do that is to calculate the number of miles you drove times the, you know, rate for mileage deduction, and then write yourself a check for that amount. That amount will be deductible out of your business. It can get a little bit goofy if you're in a situation where your margins are very thin or you don't have a lot of cash in your business and you can't afford to pay yourself back from that. The other way to do that is that you take that mileage as a ownership contribution in the company. So let's say you're owed $1,000 for mileage, but you don't have $1,000 to pay yourself back personally. Then what I would do is take the $1,000 expense for mileage, and the other side of that transaction gives you a credit as ownership stake in your business. So you've increased the investment in your business. If you're not super familiar with, you know, double entry accounting, that can be a little bit complicated to understand, but I'm happy to explain it to you and show you how to do it if you need to do that. One other common thing that people ask me about is how to account for samples, freebies, and discounts. So the first like womp womp sad thing, if you discount your products and services, which I often do, I do a lot of nonprofit work. I like to discount things for nonprofits. You are only getting a, you're accounting for that as a taxable amount is the net discounted amount. So if you, you know, I do a gig for $1,000 that normally would cost $2,000 to somebody, I'm being taxed only on the 1,000, but I don't get any sort of deduction aside from the fact that you know, you're only being taxed on that 1,000. So I think sometimes people think that they can take a write-off for that amount, but it doesn't work that way. So I would be taxed on the 1,000. That's what I got. That's what I'm taxed on. Now, a lot of y'all that have products, especially, like may be giving out samples or freebies for a variety of reasons. The best way that I would treat that is to deduct the cost of those items as part of your advertising and marketing, right? So that's one way that, you know, if you've got inventory, that you're deducting that. Now, for me, I like in the product I sell, if I deduct all of that in the year that, and I don't carry inventory, like that is, I'm deducting it already. So don't double deduct it. If you already deducted the inventory that year, you've taken credit for that. free services, you can't deduct, right? So if you've offered something pro bono, you don't get, that's just, you don't get like a charitable contribution credit or anything like that. However, you can claim expenses related to it. So let's say I go facilitate something and I have to go buy sticky notes and notepads and various things, printouts, things like that. Materials, mileage, meals associated with it, those things you can deduct. I talked about this quite a bit already at the beginning. So I won't belabor this point, but I'll flash this up here in case you want to take a picture of it. We talked about how you're taxed on the net income from the business, not just what you withdraw personally. The distributions you take will decrease that owner's equity, the retained earnings within your business. And then conversely, if you any net income that you leave in the business will increase the owner's retained earnings in the business. So let's see. I think we're almost done, and I want to come back to some of your questions here that you had, but I just want to make a couple other quick notes for you. This is not related to the normal tax cycle, but just want to give you a PSA about Washington Department of Revenue, like excise taxes. Or obviously, if you're in a retail business, you're collecting sales tax. That all kind of goes through the DOR. Make sure you're registered with the Washington Department of Revenue. They're going to advise you whether or not you'll file quarterly or annually, depending on the type of business and how much you're making. They have a pretty easy way, online tool to calculate and pay your excise taxes. Make sure that you are activating or applying for the small business credit that you can get through the Department of Revenue that reduces the amount of excise taxes that you have to pay, depending on, I think it's something like $20,000 per quarter. If you earn less than that through Washington, then you may not have to, you get a reduction in the tax you owe for that amount. Lastly, what to do if you can't pay your bill, right? So there are payment plans. So, I know sometimes people get into a bind for a variety of reasons and you can't pay your liability. You're still going to end up having to pay penalties and interest. But if you're planning to have an ongoing business, I would suggest that you apply online for a payment agreement so that you can figure out a reasonable way to pay versus trying to go underground and avoid it. At some point, it's probably going to come back and bite you. So, if you need some advice on that, I'm happy to give you some, overall kind of what I would do. But definitely if you're in that position, I think talking to a tax professional that practices every day would be good. So we've got about 15 minutes left. If you've got more specific questions that we don't get to in the next 15 minutes, feel free to jump on for a coaching session. And make sure that you file your taxes on time. I don't know what happened. I thought I had a slide in here and I poofed away that, your LLC taxes, if you are in a partnership or have multiple owners or an S Corp, are due on March 17th. Your rest of your taxes are due, your personal taxes with Schedule C are going to be due on April 15th. So for 2025. And then I hope to see you at upcoming cohorts and open houses.